Lecture 28 Breakouts Failure and Breakout Pullbacks. In this lecture, you will learn about pullbacks and the failures that follow almost all breakouts. Breakouts are usually tested by the market for failure before it is considered a successful breakout, and this test comes in form of pullbacks, and the reaction of the market to the pullbacks determines whether the breakout will be resumed or there will be a breakout failure. When there is a bull breakout, for example, two things could follow. Either the breakout will be strong enough to keep the price going up without a pullback, at least until a major resistance is approached, or after the first sudden spike, the price pulls back to test the area near the breakout point. This chart is showing an example of a bull breakout where the price breaks through this trading range to the upside, and the breaking point is just here at the resistance line of the trading range. You can notice here that the breakout was fast and the momentum was so strong that there was no significant pullback to test the breakout point. This tells that bulls didn't hesitate to buy near the high of the bull trend bars, and also that bears were completely absent, and this situation gave no chance for second entry for the conservative traders. Here is an example of a breakout that showed a pullback after the initial breakout. In this chart, you can see that the price was contained within this trading range before it breaks the support line to the downside with this strong breakout bear trend bar. Compared to the previous example where the breakout looked like a climax, you can notice here that this breakout went slowly with a pullback here that tested the breakout point, and the setup here gave a very good second entry for conservative traders. However, it's very hard to know beforehand which path the breakout will follow, and it is really a dilemma for most traders to decide which path to trade. If you buy near the high of the spike and then the market retraces to the downside, you will be caught with a losing trade. While if you decide to wait for a pullback that never comes, you might miss an opportunity that could be a big one. But we could ask ourselves, what institutional traders do during breakouts? Which path do they trade? Institutional traders usually do not wait for a deep pullback before entering the market because they are afraid that there will be no substantial pullback and they do not want to be left behind. So whenever they see a strong breakout, they usually enter the market immediately when the price goes beyond the breakout bar. For example, in this chart, a bear breakout was initiated with this strong bear trend bar, which is considered a signal bar for the breakout. Institutional traders will look to sell when the price goes below the signal bar, and the bar that exceeds it will be their entry bar. But because they are buying near the low end of the spike, they do trade with small sizes to keep their risks managed because they are aware that a pullback might happen and it could develop in any moment. If the price then follows the first path and keeps going down, they will continue adding to their short positions with smaller and smaller sizes. Buying with smaller sizes as the price goes down might seem to you as counter logic. But remember that institutional traders do not trade on adrenaline and greed. Most importantly, they do not want to be trapped near the bottom with large positions. But if the price followed the second path, as it is the case here in this breakout, where there is a pullback and a pullback reversal signal similar to this one, they will sell aggressively with large positions because the breakout is relatively confirmed and because their stop loss would be small near the high of the breakout bar. But if the pullback was deep, they will close most of their late positions either with a break even or with small losses, and they enter a wait and see mood to assess the probability of a breakout resumption after the pullback, and they will be ready to add more short positions at a higher price, and they do this also with small sizes for two reasons. The first reason is to keep the dollar value of their risk under certain amount. And the second reason for using small sizes is that they want the market to go down slowly. Because if they trade very large sizes, the market will show a climactic and fast moves. And whenever there is a climactic move, the market tends to reverse them immediately, and they do not want this to happen. So they keep adding small sizes as the price goes in their direction. And if there is a good follow through, they will not look for profit taking unless the price reaches a measured move near a strong resistance level. What most retail traders do during a breakout is pretty much different to what institutional traders do. Retail traders usually bet on a breakout failure from the very beginning, regardless of the strength signals that might be present. So, counter trend traders would buy just here, and when they see this pullback, they will be more confident to add to their counter trend long positions. They do not assess pullbacks, they treat all pullbacks as reversal points. If they are right and the pullback failed, they will take tiny profits by closing their winning counter trend trades very early. But if they are wrong and the breakout resumes, they refuse to admit that they are wrong. They will keep adding to their losing counter trend trades whenever they see small pullbacks, like this one here, as long as their margin lets them to do so. If they are lucky and the price doesn't go very far, they will have some profits on their late trades that would offset their losing ones. But if they are unlucky, as the case here, the price will keep going against them until they cannot tolerate the pain anymore, and then they will exit their trades with heavy losses. So it is a lose-lose situation for them. They either get out with a tiny profit if they are right about the breakout failure, or they will have heavy losses, or at best break even if they are wrong. This is the opposite of what institutional traders do. Institutional traders take huge profits if they are right, and they cut their losses very early if they are wrong. With these notes about common mistakes by retail traders, we come to the end of this lecture. And in the next lecture, I will show practical examples of trading breakouts.